Hello, everybody. Thank you for attending our webinar today on IRS Code Section 471C and how it may impact the dreaded IRS Code Section 280E as it affects the cannabis industry. I'm Jim Marty. I'm the CEO and founder of Bridge West. As many of you know, it's a CPA firm. We're 100% devoted to the cannabis industry and also expanding into hemp these days. So I'd like to introduce our two presenters today. We have Nick Richards. Nick is a principal with Greenspoon Martyr, a CPA firm, or excuse me, a law firm, nationally known. Nick has spent 11 years with the IRS as a tax attorney for the IRS and has about the same number of years in private practice. We also have one of my partners, Calvin Shannon. Calvin's a principal at Bridge West parent company, Beckerman, Grafstrom, and Mayer, up in the Twin Cities in Minnesota. And they're going to be presenting this new IRS code section. It's only been around for a couple of years. And with that, I'm going to hand it over to them. Thank you, everybody.
Lisa, go ahead and move the next slide. Thank you very much for the introduction, Jim. The first thing we'll talk about will be a slide Nick will present.
So thank you, Calvin. Just a quick, I'm sure most people on this call are aware of what Section 280E does, but just a quick little, just to get us all on the same page. Section 280E is part of the Internal Revenue Code dealing with income taxes, and it essentially disallows the deduction of expenditures in connection with the sale of Schedule 1 or Schedule 2 controlled substances. Basically what it says is no deduction or credit shall be allowed if the business consists of trafficking in a controlled substance. And Section 280E then is limited by the 16th Amendment of the US Constitution, which has basically falls into our Internal Revenue Code in such a way that Section 471A determines what can be cost of goods sold and what can be deductions. And that Section 471A is what has really told the tale in the cannabis industry as to the extent to which 280E can prevent them from subtracting a cost from their gross receipts.
Yeah, those are great comments, Nick. The only, I'd maybe have one additional add on to that in, trying to draw an additional distinction between what is a cost of goods sold versus what is the deduction. As Nick mentioned, cost of goods sold is not a deduction, but really rather an adjustment to gross receipts to arrive at gross income. And maybe another way to look at cost of goods sold is it's merely a term used to describe the tax basis and merchandise that is to be sold.
Yeah, and then at the end of the day, if the expense either gets allowed as a deduction or a cost of goods sold, you pay less tax in the end. The fight these days has been regarding what can be where, cost of goods sold or a deduction, because the IRS under 280E has the power to, or must, 280E says that no deductions are allowed. We ready for the next slide there, Calvin?
I think so. I think we can move on. So let's go ahead and dive into talk a little about 471C. 471C is a new provision from the Tax Cuts and Jobs Act. I'd paraphrase the language of 471C as eligible taxpayers are not required necessarily to account for inventories under 471A and may follow a method of accounting that either treats inventory as non-essential materials supplies or conforms to the taxpayer's applicable financial statements. And in the case that a taxpayer doesn't have applicable financial statements, it can account for inventories following its books and records in accordance with its accounting procedures. eligibility is basically taxpayers with less than $25 million in gross receipts in 2018, or there's an adjustment every year. So in 2019, it was $26 million. And that's measured by average sales in the previous 3 years. Additionally, the taxpayer can't be a tax shelter in order to use 471C. It appears that this reference to applicable financial statements may be an issue for some taxpayers if the taxpayer is required to issue audited GAAP financial statements to creditors, owners, or for any other non-tax purpose, which to me would probably seem to include issuing GAAP audited statements to state licensing regulators. There are a number of states that do require audited financial statements as part of their licensing requirements. For these states, probably the next question for taxpayers is to understand if GAAP would be required by these state regulators, or would possibly another basis of accounting suffice. My concern about GAAP is that a taxpayer would probably be restricted in the costs that you would potentially characterize as inventoriable by what certainly would be acceptable within the GAAP framework. Absent any statements, any applicable financial statements, the accounting method would then need to conform to the books and records of the taxpayer prepared in accordance with the taxpayer's accounting procedures. It would seem important to mention that this is probably one way the IRS could certainly punch holes in the disposition for specific taxpayers if the taxpayers didn't adequately have a set of books and records and accounting policies that supported this position with documentation. Before we move on to the next slide, Nick, would you have any additional comments?
Yeah, so I think it's that statement that's probably where the IRS will look to enforce this code section is really important, and it is the sort of the backbone of what makes this code section work, because it says that they have to conform to each other. The taxes have to conform with the general ledger, which has to conform with the accounting procedures. And that's critical. And in the cannabis industry, that oftentimes isn't the case, whether that's because of just sloppy day-to-day accounting or because of a decision to keep your books sort of as if you're just a normal business and 280E doesn't apply, and then at the end of the year to come in and do some 280E magic and then file that return. Well, that's not keeping your books in accordance with your tax return, and that'll be a problem for people. And people really need to get with their bookkeepers and accountants and make sure that they're doing their bookkeeping right, regardless of this code section. That's an essential part of having a successful business.
Yeah, absolutely. Go ahead, Nick.
So, Calvin, I don't think you told them the punchline. So what this means essentially is that, because what 471C says is that if you report your books and your tax return according to your books and records, that that's the method, right? And that would then allow a person to take costs that, or perhaps we're saying would allow a person to take costs that were previously allowed because they were termed deductions, and 280E disallows deductions, and put them into cost of goods sold, and that would potentially take away the disallowance that 280E causes. And it's really a remarkable code section, and because it says Section A does not apply, it really sort of takes away everything that we know. Everything we do around inventory accounting has to do with Section 471A. In fact, 471A is the code section that gives the IRS the authority to make the distinctions between cost of goods sold and ordinary necessary business expenses. And And here it says that that doesn't apply, and it leaves us without really any law on this at all, and no guidance either, which is a crazy place to be. And for guys like Calvin, you and I that have been doing this for a long time, and everything that we know now, it sort of, it doesn't apply anymore. You gotta ask that question, and that lack of law sort of cuts two ways. In the one sense, all the really bad case law against the cannabis industry out there is inapplicable to 471C. For the first point, 471C wasn't even enacted then. It started in 2018. So these cases are pre-2018. So that's good. That bad law doesn't apply here. But the other part is that we don't have any law that applies, and so we can't say for certain, does this work or does it not work? And I think that's a really important point here. We'll only know for sure when the courts get into this and determine what happens, or the IRS says, yeah, we think it works, or Congress makes another statement on it and changes something. So it's a remarkable code section.
And I think that's a great segue to our next slide, where we're going to explore the subsection A a little bit more. So if subsection A is really what gave the IRS teeth to prescribe how to calculate inventory and what expenditures should and shouldn't be characterized as inventoriable costs, then subsection A, and then if subsection A does not apply, it would seem to provide latitude to taxpayers to account for inventory in a way that would characterize maybe more, maybe most, maybe even all the taxpayers' cost as cost to be capitalized inventory. It would seem noteworthy that the IRS points to the related regulations in its Chief Counsel memorandum from 2015 as a source of guidance to taxpayers in what they can and can't characterize as inventoriable costs. So maybe put in other words, potentially it would be a reasonable position for taxpayers to account for inventory as described in the 471 regulations, to not account for inventory as described in the 470 regulations. This could put the taxpayer in a position where more cost would be capitalized to inventory and then included as cost of goods sold as the inventory is being sold, and consequently less of the taxpayer's cost would be non-deductible expenses subject to 280E. And Nick, you had covered a lot of this during the last slides. I don't know if you'd have anything additional beyond that.
I think you put it well, Calvin. I appreciate you letting me go first there.
All right, well, we can move on to the next slide, and Nick, you'll talk to us some about the change in accounting method and how important that'll be for the application of this.
Right. So 471C also provides for a change of accounting method, and what that is if you're doing your books and accounting for your inventory in one way, and you have to change that method, you want to change that method, you have to ask the IRS for permission to do that generally. Under Section 471C, a change of accounting method request is required. That's a Form 3115. But it is automatically accepted by the IRS. The commissioner has no discretion to deny that change of accounting method, so long as it's filed with a timely return. If it's not filed with a timely return, then you have to request permission. The 2019 year would be available for that we haven't had that filing date yet, so that would be a timely return, which makes this decision imminent, right? But the thing about that change of accounting method that's really powerful is that it is a disclosure to the IRS of what you're doing. And it is, so this isn't like something where you're, I'm, having a few glasses of Burgundy and, coming up with crazy things on the code and all that. This is what the code says. And it also says that if you have to file a change of accounting method, so that doesn't apply to the first return for a taxpayer, that change of accounting method is automatically accepted. So you get to disclose what you're doing, and the IRS can't say no. And that is what Section 471C says. And I think it's a very, very powerful statement here as to the strength of what seems to be available under Section 471C.
Nick, maybe you could, a quick question that I might have regarding the 2019 filings. So for pass-through entities that would have had a March 15th due date that were appropriately extended, then they could still apply for this automatic change on by their timely filed due date after extensions.
Yep, I believe that's true.
Okay,
not for 2018 though.
Yeah,
you'd have
so
to make
only for 2019.
And I don't even think a letter ruling request is available for 2018 at this point either. I haven't had a client wanted me to look hard enough at that yet, so I don't know for sure.
And then for 2019 returns that haven't been filed yet, the due date obviously got pushed back till July 15th. So you'd have till then, or if you were able to timely file an extension by July 15th, then that would push it out to the extended due date for C Corps.
I believe that's true.
Excellent. Well,
yeah, consult your accounting professional on all that stuff, right?
Absolutely. So we can move on to the next slide.
Yep. Is this me, Calvin?
Yep. You were going to give your thoughts on will this work? I can add a couple comments towards the end.
Will this work? So, as I said, and you said earlier as well, this is a new thing. 471A and the law that has previously guided us around 280E doesn't appear applicable with regard to 471C in large part. Is it trafficking? Yeah, that's applicable. This code section sort of took on added sort of emphasis, added breadth with a March 30th TIGTA report that came out this year. TIGTA is the Treasury Inspector General's office. TIGTA is basically a federal agency that audits other federal agencies, and they did an audit of the IRS's 280E audit program. They're auditing the audit of the auditors, right? In that report, they report what they found, and it's about 50 or so pages, maybe a little longer than that. And what they found is that these 280E audits is the best thing the IRS has going as far as dollars assessed per man hour. And as a matter of fact, the standard IRS audits are done under something called unless they're random, under something called a DIF score, which is like the IRS's secret sauce that can find the problem returns and select them for audit. And those DIF score audits produce an average of something like 30, 35, 38, I can't remember what it is, $1,000 per audit, whereas these cannabis audits produce an average of something like $150,000 per audit. And so they are much more, a much bigger thing for the IRS as far as productivity with assessments is concerned. Now, if they're collecting this is another question, but that in that same report, after TIGTA said, do more of these audits and coordinate better, and here's how you can do these audits better, they talked about 471C, and they said something to the effect of, well, there it is on your screen. Qualified businesses would not be, or it suggested, it says, the 471C would suggest that qualified businesses would not be subject to the general rules of accounting. Instead, they may elect to use their internal financial statements to account for costs in lieu of keeping inventories in a manner otherwise required and avoid Section 280E. In that same statement, the IRS clarifies that costs of goods sold are not expenses, and so they sort of say this statement that would lead you to believe that that's this sort of big stone fence separation between the two. such that that makes the determination, does 280E apply or not? And then they say nothing regarding the suggestion that 471C may eliminate 280E. And as a matter of fact, what they say is then redacted. And so, you know, that got a lot of us thinking, boy, what's going on here? Because that report is full of statements of the IRS. And suddenly on this one, they can't speak publicly. And they don't even say, no, we don't think it applies. And when the Treasury Inspector General comes out with, well, okay, well, you know, you should issue some guidance here, they say, well, we got better things to do. So that really was a glaring piece of governmental reporting that came out just, you know, a little over a month ago. And so the next point on there, legislative grace, is very interesting. Early on, we started and we talked about that. What 471C says is, if you report your books and records according to your internal accounting procedures and records, I mean taxes according to those records, then that reporting shall not fail to reflect income. And 471A doesn't apply. That term income is a huge deal. Income is what we're talking about. Income is the sort of genesis of the Internal Revenue Code in many ways. The 16th Amendment created our tax system as we know it today. And what the 16th Amendment says is that Congress has the right to tax income. Well, here Congress is saying, if you do this correctly, it shall not fail to reflect income. That appears to be the ultimate statement in the tax world, that has a ton of power behind it. And that power is the power of legislative grace, which thus far in all of our cases has been used to justify the horrible result that 280E causes, and is the same principle that would apply to 471C, because 471C is a legislatively enacted law, and in the world of internal revenue tax, federal tax, law is the highest piece of it, right? Then you have regulations, and you know, you can have court rulings on that, but the court would be bound to many extents to what the legislature determined. And so really the question would be, if it went up to the Supreme Court, is this unconstitutional for the legislature to allow this to happen? And because the legislature has a power over income, clearly they've used that term to include the full scope of their power there, which is why there is this suggestion that it could be used to put all costs into cost of goods sold. So that legislative grace, which has been the horrible part for the industry for so long, is maybe getting to be something that we can use on our side now. And then Calvin, did you chime in there?
Nope, not at all.
Oh, okay.
I have a couple of comments, but I was going to kind of wait for you to finish up.
Yep, and so 263 Cap A is also interesting. Early on, we thought that we could use, many in the industry thought they could use 263 Cap A to sort of broaden the cost of goods sold for taxpayers, and it does that for other non-cannabis taxpayers. And there was an article that was written by a colleague of mine at the University of Denver, Professor Roach is his name, I'm not kidding. And he said, hey, you know, industry 280E is not such a big deal, check out 263 Cap A. And shortly thereafter, the IRS came out with a chief counsel memorandum that said, no, you can't use 263 Cap A because a couple years or after 263 Cap A was first passed with legislative grace, the legislature came back and added in flush language. And that flush language says that you can't use 263 Cap A to turn a non-deductible expense into cost of goods sold. And so that has 280E creates non-deductible expenses, and so 263 Cap A is not available to the industry. The important piece there is that there is no such language in 471C. There is no, quote, flush language. And so it would seem that according to sort of the history of tax policy and you know, development, that would be necessary to stop the industry from using 471C to move costs into cost of goods sold. So another factor that so far has been very bad for the industry, but in the context of 471C seems to be on the industry's side.
You know, Nick, the one thing that I was thinking about for 263A, you know, as you discussed, that there's not similar language as there is in 263A about not changing a non-deductible expense into deductible by using it. In some of the court cases, the IRS, that's what the IRS was successful in using in blocking attempts to use 263A to recharacterize some of the expenses as inventoriable, and the courts agreed with it, and that was how they pushed that along forward. So without that, you know, taxpayers certainly would probably have a better argument supporting their position in this regard.
Well, and you know, it's interesting. On that 263 Cap A, I've always felt like the courts and the court decisions never really gave it a good discussion as to why it was disallowed. They just cite the chief counsel memo and they say it's not allowed. In a way, that is the right answer because of 471A. 471A says here, you IRS, you have the authority to determine. And so if chief counsel memo says you don't get it, that authority is there, right? Again, 471C says you don't have that authority, IRS. So it is remarkably broad in what it encompasses here.
Yeah, absolutely. It's a great point. And I'm going to jump back to the beginning discussion regarding this slide and make one comment regarding the TIDCA report. When I had first read it, what honestly really jumped out at me, and Nick had briefly discussed this when he was talking, but the report is set up in a way that the inspector makes recommendations directly to the IRS, and then the IRS would respond with what they think about the recommendation, basically. So the Inspector General came out and said, you know what, you should coordinate and communicate with taxpayers on exactly how to handle this 471C issue. And in the response, right in the report, the IRS, as Nick said, just came out and said, no, we disagree with this. We don't really have the resources, and we're tied up trying to basically deal with the Tax Cuts and Jobs Act, which honestly, this is part of the Tax Cuts and Jobs Act anyway. But at any rate, I just thought that was a really interesting part of that report. And then the report generally, I would suggest it for really anyone in the industry to go ahead and read it. It's a great report. As Nick mentioned, the Inspector General talked a lot about the ground that the IRS could make as far as audits of 280E companies. So just interesting, probably really relevant to a lot of license holders. That's all I have with that slide. Could move on to the next. So this is actually a hypothetical example that we took. It's an excerpt directly out of the TIDCA report, and there's a couple interesting points that I would bring up about this. The first one being that what the Inspector General, they're literally trying to illustrate here, under 471C, you could see that they've moved all the what were previously non-deductible expenses into cost of goods sold. So they're trying to illustrate this is what this would look like. IRS, you should probably pay attention to it, or at least that's how I'm interpreting it. The other comment I would make that I think is slightly misleading about it, and probably very important for taxpayers that would be considering this position, is that this it basically reflects all of these additional costs that we would be characterizing as inventoriable cost as deducted in the current year And the reality is a number of those would probably still be stuck in inventory at the year end. So the idea that all of them would slip up the cost of goods sold is probably not quite accurate. Some of them would probably remain on the balance sheet and be deducted in the subsequent year, which is still good. It's just you have to wait till the next year to benefit from that. Nick, unless you'd have any more comments about this particular slide, we can probably move on.
Sorry, somebody at my door. I just want to, Calvin, I can't see the bottom of the table there. The punchline, I think, is that it makes a big difference in the tax you pay, right? So maybe that's just my screen, but no, I don't have anything more to add here.
Okay, well, we can move on to the next slide. So this last slide is kind of a summary slide where we maybe go through a checklist of what taxpayers would really need to consider if they were thinking of taking this position. So I figured we'd just kind of roll down these bullet points. Maybe Nick, do you want to take the first one about this? This would probably require a change of accounting. That was a slide that you had discussed.
Yeah, so for anyone with pre-existing return that they filed, this probably requires a change of accounting method. As I said before, if that's with a timely return, it is automatically accepted by the commissioner. And if it's otherwise, you have to request permission to do it. That change of accounting method is basically a disclosure of exactly what you're going to do. And what you're going to do is report your taxes according to Section 471C 1B 2 little I, if we want to be really technical, and I do. Calvin, you and I and Jim were having a little discussion before this panel on this change of accounting method, and I think this is really important. And in many ways, I think that the 471C 1B 2 little I method is really what the industry does. It's not really it's not GAAP, right? I mean, there might be some strictly GAAP taxpayers out there, but many of people are doing things that are sort of trying to get close to GAAP, but there's a lot of gray areas and doing allocations and figuring out this and figuring out that, and trying to find a reasonable approach to getting as close as you can. 471C is, and the accounting method change would authorize that in many ways. So it's really a critical piece to this 471C procedure.
Yeah, absolutely. I definitely agree with that comment. Maybe just to discuss a little bit more, some examples. I guess what I would look at, Nick referenced in industry, tax preparers are trying to look at different, but before even 471C, trying to look at different expenses that could possibly be characterized as an inventoriable cost and end up in cost of goods sold. What comes to mind right away is security. Expenditures like that I know we've often taken the position that should be an inventoriable cost and then reflected in cost of goods sold. Labor associated with security, possibly even labor associated with counting and securing inventory, things like that. Absolutely.
Yeah, and there's a difference generally that I'm seeing in the audits that I'm handling and what the agents feel is a sort of a reasonable effort there, and then the sort of very sort of all or nothing sort of approach that we see from the tax court decisions oftentimes, and that I think are these tax court decisions are largely trying to defeat 280E and take a position that is that 280E is unconstitutional. And in the end, we end up losing on the little parts because it doesn't seem like there's very good, adequate records that are there to support that a cost like security for storage or security for a acquisition space can be properly added into cost of goods sold, but yet the agents understand that, and you can see that in the audit. So there's this sort of 280E flips a lot of stuff on its head that we normally would do for a non-cannabis taxpayer, and it is that method that is very much the 471C method.
Yeah,
you know, so that next I'm sorry, Calvin, I was going to go to the next bullet, but I'll let you go.
No, well, I honestly was going to do the same thing. I was just say that's a great transition to the next bullet point. That I'll say a couple things about it. Then Nick, you can add some more. But basically, and we had mentioned this before, the having accurate, well-documented, complete accounting records, a GL, accounting policies that reflect the position that we're taking regarding 471C, or frankly, even the position that you're taking pre-471C, it is really critical. And I mentioned before, I think it's really the avenue, or certainly one of the avenues that the IRS would probably attack first if they were trying to push back on this position.
Yeah, and it's an area that will lead to penalties too. You know, the code section 471C is very simple. It says what it says, and there's not a lot. I mean, you don't have to. Here, I've got my internal revenue code here. This is just volume 2 of the code. There's another volume, and then there's 6 of these books for the regulations. Right, 471C is this much of one page. And it's really simple. And it says what it says. And if you don't do it correctly, you'll find that'll be seen as you know, negligent, I think. And the recent case in Harborside is a good example. Harborside had great books and records. Their books and records were completely up to date. They supported the position that they believed in and tried to defend in that tax court case. And as a result, they were not subject to penalties. And that is very much the situation, I think, with 471C, where if you just think, oh, this is easy, I'll just do it at the end of the year, I don't need it. I mean, you know, I'll save money and not pay my bookkeeper. You're going to end up in a bad position with regard to 471C. It needs to be done right. And if you do it right, it says what it says, right? So it's a big deal. That next slide, though, that next bullet point, Calvin, taxpayers should understand the risk and proceed with caution, right? Again, brand new stuff, we don't know for sure. And we don't have any law on this, and the law we have in large part doesn't apply. So it is a decision that I think the taxpayer has to make. And there's a lot of dollar signs on these decisions. You know, I've got clients that this is, you know, more than $1 million a year in money in their pocket at the end of the day. And so it's a critical thing. It's a critical thing.
Yeah, I guess what I would advise taxpayers who are considering doing this is honestly probably calculate how much exposure you have. If work with your tax preparer or your professional to calculate how much exposure you really have, and keep that in mind. Understand what your risk is. Nick had mentioned something earlier about even if this doesn't work and IRS is successful in a court case, with the language it is, it probably at a minimum give you coverage for penalties. That said, still probably even understand, you know, the possible penalties. Just working with your professional to make sure you know what your exposure is, and then that kind of leads to the next bullet point. Understand how much you could potentially be out if this gets overturned, and probably make sure you keep that cash available for some time.
No new Teslas on this, guys.
Then the all or nothing. That honestly, that's a really good question. Something to think about. I think that the way the 471C is written, you certainly have the option to kind of go middle of the road, try not to be so aggressive and return. limiting what your exposure might be if it's overturned, that as Nick had discussed, the language literally says it's up to you, so long as it's supported by your records. So maybe your records reflects not such an aggressive stance regarding what you would characterize as inventoriable cost, or maybe it would. That's a decision that you would make in consultation with your tax professional.
Mm-hmm.
What do you think, Nick?
Yeah, it would appear that 471C is broad enough. You could put everything into a deduction and get nothing under 471C, and the opposite appears equally true. 471C doesn't say anything about any particular type of expense. It doesn't mention cost of goods sold or deductions. It just says what it says, and it would appear that it would enable everything from one side of that distinction to another. And so long as your books and accounting procedures, which is another, that's two things, conform to your tax return. And I think that one thing we didn't also say, Calvin, is contemporaneous books and records. Let's do this right as it's happening in our monthly accounting. I mean, it doesn't have to be by the hour, of course, but let's keep up with this and do it right. I think that's really important.
Absolutely, that's a great point, Nick. That just further support that this really is your underlying books and records. And as a side note, not a terrible thing for any business owner to have good records to understand how his business is doing on a month-to-month basis.
Which is an interesting point, right? Let me say this, Calvin. Knowing how your business is on a month-to-month basis, if you're a producer of a good, what you want to know is how much is it costing you to produce that good? That's really what you need to know, right? And to truly know that, you would put everything into cost of goods sold and then be able to have a unit price per unit sold, right? I mean, if you're a producer of marijuana, you want to know how much it costs you to produce a gram of marijuana. That tells you how much you need to sell it for. Yep. And in order to do that, you got to add all your costs into that gram, right? And so the position of everything cost of goods sold has a legitimate business purpose. It's not, something that is just so far off the tracks that it's ridiculous. In fact, I'd go even so far as to say that, but for the timing difference that Section 471A in the Revenue Code causes in the name of income, but for that, producers would put everything into cost of goods sold. There wouldn't be a distinction. You'd want to know what your total cost is per gram, right? So it has an interesting take to it.
Yeah, that's a great point. So the last bullet point, Nick, maybe I'll let you discuss protective claim. We could briefly go over that. I believe we've got a number of questions, so maybe we could.
Okay, I'll hit it real fast
and try to move to the questions.
So basically, a protective claim is where you file a return and take a position on that return, and then you file another return as a protective claim. And on that return for protective claim, you are saying, "Hey, IRS, I've taken this position. It was a valid position for me to take. I think it was right, but just in case, I have filed this protective claim for refund in case it ends up that I'm incorrect." And that's something that you should talk to your tax advisor about. It could be a wise move here.
Well, great job, guys. Lots of good information. And, your final points there about the expenses and what are your costs. I mean, so many of the expenses in this industry are mandated by the state. Your rent, you have to have a location. Your labor, you have to have highly trained professional bud tenders dispensing your product. So you guys made a lot of good points, and we'll see where this goes going forward. Yeah, we have several questions. I'll take care of the most frequent question, which is, can you get copies of the slides? And the answer is yes. You can reach out to our administrative person, Lisa, on this, and she will make sure anybody who wants slides gets them. We have the list of attendees, so we won't have any trouble getting you those. And with that, I'm just going to turn it back to Calvin and Nick to take on some of these really good questions that our audience has asked this morning.
Yeah. The first question that, and we'll try to get through as many of these as possible, and to the extent we don't get them answered on air, then we'll probably try to get to you separately anyhow. But what if not the state, but a lender investor requires applicable financial statements, specifically IFRS? So that's actually a really good question, and I had thought about the IFRS specifically. What the definition of applicable financial statements is audited GAAP statements that are for, like I had mentioned before, a owner or a creditor or for any other non-tax purpose. Then it does go on to discuss IFRS if the IFRS was used basically for an exchange, if they were an issuer for a publicly traded company. So an IFRS statement that is only for a creditor, that's a good question. And actually, I have a client that has that exact situation, and it's something I'm thinking about. I guess it's a harder question. So to the extent that you know the taxpayer asking the question would want to follow up with this, maybe we could have a longer conversation about it. So Nick, would you have any more comments about that?
I think you're right, and it could have to do with entities too. You know, I think there are a number of companies that are owned by Canadian public companies that have IFR requirements that are submitted to an exchange, and there's an issue there on, is the U.S. sub included in that IFRS question there, and that's definitely a more technical question that you'd have to look into and go through the regs on, or go through the code on. There are no regs.
The next question is, does what you're suggesting run afoul of various attempts at cramming 263A into the cost of goods sold conundrum? And I think we had kind of touched on that pretty well. The discussion regarding the flush language at the end of 263A, and really the absence of any similar language in 471C. So I guess from my perspective, I have some comfort in that it doesn't run afoul of that. As both Nick and I had mentioned before, is there any absolute guarantee that that the IRS wouldn't have some success similar to what they had for 263 and tax court? I couldn't necessarily say that, but it seems to me we have a pretty good position. Nick, what do you think?
Yeah, you know, it would seem that the reasoning behind disallowing 263 Cap A in the context of 471A, right, and the regulations regarding cost of goods sold, and that reasoning and that flush language, it's the absence of it in 471C would seem to me that the reasoning would then support the method under 471C in many ways. I think the question is sort of, I would like to broaden it and say, isn't what you're really asking, are the principles underlying 471A and 471C, are those principles in some way, do they still exist if we strip away those code sections? And we don't know. I don't know of any sort of you know, bedrock principles that would come in and override what Congress did here. And you know, again, this is the Internal Revenue Code. It's way up there. So yeah.
Is this retroactive for the 2019 tax year? And, you know, again, something that, you know, I think we addressed actually all the way back to 2018. just there's some difficulties regarding, you know, the need for changing your accounting method. I don't know, Nick, probably not much more to say about that.
If you made a 471C election in 2018 because you learned about the IRS position of conceding work in process, or WIP as they call it, that's interesting. You may already be entitled to change your books and start moving stuff into cost of goods sold. And so that would be something to talk to your tax advisor about. You might already made that accounting method change, and in which case then we would want to look closer at that and see exactly what that change was. What did it say? And are you already there?
The next question, does this mean that we need to record tax depreciation in the books, not GAAP depreciation? I guess I don't know for sure what the questioner is asking, but I'll make a couple comments. So let's say even before 471C, when we're really using the regs from 471 to capitalize some depreciation that would be related to production, those regs were clear that depreciation had to be consistent with GAAP. So for the most part, we've always used GAAP depreciation for preparing tax returns that are subject to 280E, which would mean, you know, bonus depreciation and 179 probably aren't necessarily consistent with GAAP. If the question means, do you have to use tax depreciation in your books if you're going to use 471C? I think, again, the answer is probably no. And it goes back to the answer that it's whatever your documented and supported accounting for inventory. If you use GAAP, then that would probably seem good. If you use tax, I guess I don't know why that couldn't work either. I don't. Did you have a thought on that, Nick?
I think that I have more of a practical kind of answer to that. If you already have assets that you're depreciating under a certain method, it would seem to me that continuing to do it under that method and calling that the 471C method is probably the easiest thing to do. Do you accelerate all that into the year? I would want to look a little closer at the depreciation rules. If I had a client that was looking to accelerate all of their depreciation into the 2019 year. But let me say this, as you said, Calvin, the 471C, it doesn't say anything about it, doesn't limit it. There is nothing in that code section that would say you cannot do that. And so again, it's amazingly broad.
While the risk of 471C includes repayment of any taxes and interest, is there significant risk of excess penalties? You know, this is, I think, a question that we had touched on earlier. And I guess from my perspective, I wouldn't feel comfortable saying absolutely not, there's no risk of penalties. It appears that the way the code section is written, that there's certainly some cover for a taxpayer wanting to take that position. And then, you know, the other comment, and Nick, you can correct me if I'm wrong, I believe it was the Harborside case where the tax court actually, to the extent the taxpayers did have good records and accounting records and documentation, that they did get some release from penalties. Am I right about that, or maybe it was a different court case? I can't remember for sure.
Calvin, that's every court case. You know, penalties aren't just because you do something and the code says something else. Penalties are because of what else you did. And you know, are you credible? Do they think you're lying? Do they think that you are trying to do it correct, or do they think that you are trying to pull a fast one. So there's a lot to that, and I think there is real risk of penalties here if you don't do it right. And I think that's very important, because I think the very essence of this code section has to do with the matching of the books and records to the return. That's the critical piece. And if you don't do that, I think you could be looking at penalties here. But absent that, it seems to me that this code section says to do something, and if you follow those directions, then it shouldn't be the kind of situation that would lead to penalties. There will be interest if it's wrong. There'll be interest, and you have to pay the tax, and you've got to pay your lawyer, I suppose, too, if you want to fight it in court. And we have to assume somebody will. But it seems like, based on the Harborside case and all the cases that have come before it, if you really have good books and records, and you follow the directions of your CPA and your lawyer, and you do it right, then it seems to me that you have reasonable cause here for taking the position, and the negligence penalty shouldn't apply.
Yeah, no, I absolutely agree. The next question is a pretty interesting question. If the legislative fix to 471C disallows use in the future, would it only apply going forward, not retroactively? I am probably going to fully defer to an attorney on this.
That is an amazing question, Calvin. You see, I'm getting goosebumps on this one. And here's why. So tax changes are not retroactive. They apply to the year, like this one was this 2017 TC&JA, and applied to the 2018 year. That I've never seen a code provision to reach back into other years that are for which returns are already filed, and maybe there are some. But the amazing thing for me here is, if you do make a 471C 1B 2i election, and then the IRS convinces Congress to come back, or just Congress decides to come back and add in flush language, you now have a approved change of accounting procedure that is according to income. And the question is, in that situation, could those changes force you to change that accounting procedure moving forward even? And it seems to me that there could be some difficulties there. I haven't run that road all the way down, but the fact that is a possibility feels to me like, even if you are a taxpayer that says, look, I'm really scared of this, we're doing fine, I'm not going to do it, we could get down the road where the people that did it get to keep it, and those that didn't don't get to do it. And that I don't know if that's where we're going or not, but I have that fear a little bit.
Yeah, I definitely understand your point there. How does this apply to companies that aren't in the cannabis industry? Can it be beneficial for them as well? And I would say, so long as you meet the requirements, the answer to the first question is, so long as you meet the requirements, yeah, you definitely could use 471C to get out of having to follow the regulations under subsection A. But the next question might be even a better question, is, can it be beneficial for you? I guess I'm not fully ready to answer that question. I probably wouldn't have my head around that right away. The question would be, is you're obviously not concerned about getting deductions that would otherwise be subject to 280E, to the extent you use this to accelerate what would otherwise be held up and not deducted because it's held up in inventory. So it's kind of a timing question that could possibly be an avenue. But obviously that's the exact opposite of where our mindset is right now.
So
yeah, I think that's right, Calvin. It would go the other way, right? You wouldn't take an all COGS position. You'd take an all deductions position.
Yep.
Jim, that's probably what you were going to say.
Yes, I was just jumping in to let you know that we're coming to the end of our hour here. So great questions. Calvin, do you want to squeeze one more question in?
Yeah, maybe before I'll do that, I apologize to everyone that Nick and I didn't have a chance to get to your questions, but as you could see on this last slide here, both our phone numbers and email addresses are available. So, we'd love to talk more with anyone who in the industry that would like to discuss this further, your questions or any other questions. That said, we'll try to go ahead and do one more question. Any ideas as to what the intent of this section was? Was it included in the TC&JA? And the answer to that question is yes, it was part of the Tax Cuts and Jobs Act. And my thought on what the intention was by Congress was to simplify accounting requirements for smaller taxpayers. Nick, do you have any other perspective on that?
Yeah, and I embedded in that question is, what was their intention with regard to the cannabis industry? And I think that the answer to that is they had no intention with regard to the cannabis industry. They passed a code section that made it easier for small businesses, and they didn't try to single out the cannabis industry and prevent them from benefiting from it. And so, what was their, can we say their intent was to give the cannabis industry a break? I don't think so. But I don't think we can say that their intent was to hurt the cannabis industry and they just didn't get it right. I don't think that's right either. So I think it was their broad-based intent to provide relief to small businesses.
Yes.
I guess maybe the one additional comment I could make, from the TIGA report, the Inspector General, if I remember correctly, they did come in with their opinion on what this intent was, or lack of intent with the cannabis industry. I believe the words they used were something like the unintended consequences of making this a possibility for companies subject to 280. I believe that might be a paraphrase, but it's probably pretty close to their exact wording. So I thought that was interesting as well.
And Calvin, they kind of put that in the mouth of the two representatives that have mentioned the 471C method to the IRS, which was kind of a cheap shot, I thought. I don't know any representatives out there that would say that this was unintended consequences, right? I mean, that's they're talking. That's not the cannabis industry.
Yeah, I'd make a comment in closing that keep in mind, this was passed when the Republicans were in charge of both houses of Congress and the presidency. So it's
right.
Very typical, not to get political, just observational, that very typical Republican empowering the taxpayer, especially the part of it where it says the IRS cannot change this once the taxpayer elects it.
Yeah.
Yep.
So with that, I think we'll close it out. Great job. Thanks to Nick Richards, my partner, Calvin Shannon. Please feel free to reach out to either one of them. You have their contact information here. And we will probably follow this up here in a few months as we see how IRS Code Section 471C works out in practice. Thank you all very much.
Yep, absolutely.
Jim, thank you.